Early in my career, I worked in more of a trading capacity. We used to joke about how time went too quickly when markets were going up, but agonizingly slow when they went lower. I started thinking about that dynamic as we approached the end of June. I probably live and breathe this stuff more than most, but the last 3 months seemed to pass much slower than normal. Despite how it felt, markets for the full period were actually pretty good. Bonds ended up more or less flat, and stocks were up nicely. That wasn't the case for a lot of the past quarter though, particularly the early April timeframe. Given how long ago that now feels, a short recap may be helpful. Let's start with where things stood as we entered April, just prior to the Tax Liberation Day tariff announcements and the volatility and uncertainty that followed. While the second quarter would prove to be quite eventful, there were also some interesting trends developing through the first couple of months of the year, most notably the outperformance of international equities, the underperformance of tax-exempt muni bonds, and weakness in both U.S. equities and the dollar. Now, a lot would change after the market closed on April 2nd with the tariff announcements by the Trump administration. After the tariff announcement, the bond market reaction was relatively tame, but equities sold off meaningfully, with U.S. equities falling by more than 10% over just a 2-day period. It's not that investors didn't know the tariffs were coming. After all, the new administration had already started selectively using them against Canada, Mexico, and China, and had communicated since mid-February that they aim to implement reciprocal tariffs against other countries. So while the April 2nd announcement of reciprocal tariffs wasn't a surprise, the scale and scope of the tariffs was. Wall Street had, of course, attempted to predict what the administration might put forth, but it simply underestimated both the tariff levels and how many countries would be targeted. I should back up a bit and mention that while U.S. equities fell more than 10% in the days after the announcement, if we go back to the highest point in mid-February, they had actually fallen closer to 20% in total by the close of trading on April 8th. Fortunately, April 8th would also mark the low point for markets as the following day, President Trump issued a 90-day suspension of most of the tariffs announced the prior week. The market reacted very positively, with U.S. equities rallying more than 9% by the end of trading that day. The 90-day reprieve may prove only temporary, but it clearly shifted market sentiment and provided comfort that the new administration would consider economic and market consequences as it moved forward. Tariff concerns remain, but investors have been able to shift some of their attention back to earnings, inflation, and some of the more market-friendly policy initiatives like the extension of the 2017 tax cuts and greater deregulation. It wasn't immediate, but as our graph shows, equities not only recovered from their early April sell-off, but they ended up having a rather strong quarter. One thing that curiously did not recover was the US dollar. It was weak during the first quarter, fell during the early April tariff saga, and then never really got any positive traction in either May or June. So where does all this now put us through the end of June? Despite all the volatility and the continued uncertainty, I'm happy to say that most investors have likely enjoyed gains year to date and are now in better shape than they were at the end of the first quarter. Interestingly, many of the same trends from the first quarter remain in place. International equities are outperforming, tax-exempt muni bonds have yet to sync back up with taxable bonds, and the US dollar continues to be weak, which, as an aside, is part of why international equities have outperformed as much as they have. All in all, it's been an eventful but mostly positive 2025 so far. As always, thank you for watching. If you have questions or would like to talk about your personal wealth management needs, please contact us at the number or email shown at the close of this segment.